first rates. Not too many newsmakers over the weekend, but the ones which are important. First, I'll mark the Sensex and the Nifty, and then metal stocks, given that material prices, metal prices, crude prices, commodity prices, all of them have seen a significant uptick. So Sensex off to a good start. The market breadth, whoa, 1:14. Nobody wants to sell. Everybody wants to buy. And that is what happens. 1:14, I think, is a phenomenal number for the market breadth. So Hindalco, L&T, Hero MotoCorp, JSW Steel and iShares. That's how the markets have opened. The small cap index well in the green, the mid cap index well in the green. Now the newsmaker space. Kotak Mahindra Bank and Jio Financials. Kotak Mahindra Bank, because Mr. Kotak has decided to step down 4 months ahead of his tenure or his term. It's not having any impact whatsoever, positive or negative, on the stock of Kotak Mahindra Bank. The second is Jio Financials. The circuit has gone from 4 to 20, and that's not having impact on the stock per se right now. The stock is at 253, up about 4%.
Right, okay. A bunch of auto sales numbers as well came out post-Friday market hours. So Hero MotoCorp, the August sales are actually above what the market was anticipating. It's an uptick of 24% on a month-on-month basis. For iShares, Royal Enfield sales have risen 11% on a year-on-year basis. iShares Motors makes a comeback of about 1.25% as we speak right now. Let's check in on what IDFC First Bank is up to as well, because the bulk deal data did suggest that GQG has bought shares and now holds about 2.6% stake in IDFC First Bank. That stock has gapped up about 1.5 or 2.5% actually as we speak right now. Let's revisit what Nazara as well is up to, since we're on the subject and the news just came by. That stock will just be up for you on your screens. And Biocon, which has acquired Eva Pharma's oral solid dosage manufacturing facility in New Jersey for a consideration of $7.7 million. Biocon up by about almost 1% as we speak. Shree Cement, let's check in on that. Besides, of course, all the news flow and the channel checks suggesting that there have been upticks in cement prices. You've also got Nomura, which has upgraded now Shree Cement to a buy from the earlier reduce, and they've upped their target price also to $28,700, 2% higher for Shree Cement as we speak right now. And then, of course, the high flyers, your Titagarh, RITES, IRFC, IRCON, BHEL, SAIL, the entire PSU chunk, and it continues to hold a buzz today too. Look at the railway stocks. They refuse to let go, or for that matter, even BHEL, which was a big mover all through last week. And today as well, it starts off well in the green. Naresh, what are the first trades you're tempted to punch in?
So that is IndusInd Bank. That's the one stock which is waiting for a breakout about the 1430, 1440 mark. So preempting a breakout in IndusInd Bank looks interesting.
Rudra, let's find out what's on your radar this morning.
See, for me, Max Financial is making a base formation and can give a big move on the upside. So I will be a buyer in Max Financial, and at current market price, I will look at buying and on dips to 920 for a target of 1000 plus for a positional trade.
All right. Venugopal Garre, Managing Director with Winston, joins us now. Let's understand from him the global construct and what is he advising in clients in terms of the near-term dynamics. Venu, good morning. Thank you for joining us. The markets have done very well for themselves. What's next? Because some would argue and say that all the triggers in terms of macro, micro, inflation, crude prices, earnings, everything is played out. What's next which will propel the markets higher?
Yeah, thanks a lot. I mean, this is the most important question to answer now. I guess the call earlier this year was fairly easy. In fact, my own journey has been, as we discussed earlier, was that I upgraded the market in the first week of April to a buy, after being underweight for the first quarter of the year. Now, there was, of course, a lot of factors which drove that call of ours at that point of time, especially centered around the bottoming of the economy. Now, to a large extent, that's played out. So what we did just about 2 months back is we sort of reasserted our positive call, but then started to say that the broader markets will continue to do well, while the index perhaps will just float around the range. When I say broader markets, technically means everything around SMID. Now, the reality is, if you look at the last 1.5 months, we've started to see a situation where momentum in SMID has been fairly strong. And most of these themes and ideas are getting priced in quite quickly. The question simply is that from here, should one sort of start turning to really negative on the market? But when I look at the broader global construct, our thinking was to still say generally positive on the markets, but at the same time, the argument for us was that things like global commodities, they're okay at this juncture, not really necessarily a negative driver for India. More importantly, I think global growth will still moderate through the year. There are chances of that, and primarily means that we benefiting from that as a country will still remain as a theory. The second part is, at least from what I look at is the GDP construct. It will be a very first half heavy, especially given the fact that we are preponing a lot of these government spends. So to that extent, I'll probably say that, when it comes to weakness in macro parameters, probably we'll start seeing that a bit in, let's say, December month or the March quarter, where things will be weaker heading into elections. So to that extent, we'll continue to get some positive momentum in the economy. So there's no reason to be outright negative on the markets at this juncture. So what we do in such a situation where the domestic economy is okay and global economy is actually helping us rather than anything else, we then don't really change a call. We allow the market to basically, run its course. Given the fact that we don't really see too much of downside risks at this juncture. So that's the way we are essentially following. There's no change to our Nifty targets, pretty much in this range. But I don't call myself as a seller of the Indian market at this juncture.
Not a seller, and you do believe that the downside is capped, but is Venu the upside capped as well?
Upside is purely a function of time frames right now. So if you were to look at let's say another 8-9 months, what is a big event in India, right? We are all going to be talking about elections. You probably started seeing a lot of reports out in the market as well, right? Centered around election activity, who will win. I think the biggest touch point for India is elections. And we really don't know what's going to happen in this, sort of, parliament session, which is also be called later for this month. If we're going to be doing anything around, state election, central election merger, how does the market look at that, and especially around the prospects of the current government coming to power. Now, one thing is very clear to me that if I were to look from here till the next 8-9 months, if the same government remains in power, it's a powerful enough driver for the markets, which is that that more momentum which comes in because people get comfort that hey, for the next 5 years beyond that, we have at least clarity on policies. So markets are going to be much higher in June, July next year than they are today, right? And what could, of course, mean that a lot of these large cap laggards, you haven't really seen financial sector being significantly up year to date. Neither has been, some of the larger stocks like Reliance, for example. The market is up, 6-7% year to date, right? So especially given the fact that large caps, quite a few of them haven't moved. So timeframes with this being the one important touch point as to what happens with respect to the political events and macro prospects post that.
Okay. If markets are trading above the historical valuations, do you think the near-term returns will get compromised, whether it is before election or after election? Ultimately, it's the price point which matters. So if one looks at the current price point, factor in all the economic growth which currently is projected, do you think now we are in for, let's say, low single-digit returns or at max early double-digit return in terms of in 3-year compounding?
I think probably 3-year compounding, perhaps not. And the reason being that, if I look at the two main things here, I think it's also construct of earnings cycle. I think most of consensus is looking at mid-teens numbers in terms of earnings. And, as I had broadly indicated earlier as well, a lot of the earnings construct is driven through margins rather than largely through top line growth. And a part of the theory that I see for the market is beyond politics is the fact that we're still early cycle as an economy. So I do believe there's a room for a decent cycle shaping up in India over the next 3-4 years. So what it means is that, from a purely CAGR perspective, we could be probably higher than the low double-digit number if I take a 3-year view. The problems and challenges are more about the next 6 to 8 months. Are you going to generate 4-5% returns from here or probably be flat or down? I am more at an index level in the flattish sort of a camp at this juncture for the near term at least. But at the same time, I do believe that market is going to chase some of these small caps, where people don't really bother about valuations, right? Which is more thematic, in given that these companies can disproportionately see earnings rises as well. So bottom up picking perhaps important to a large extent at this juncture. If I take a 6-month view, and SMIDs, even within that, you're just chasing momentum in certain places, but then you don't really have a valuation anchor in place. But on a 3-year view, I think I would still want to be believing that we're going in for a decent return journey.
I was just going through one of your reports, Venu, and, while it's about financial inclusion, and I think that's the India of the last decade, it's also about the infrastructure growth, which you also talk about in your note. How can investors stand to benefit from it? And do you think this is the theme which is going to be prevalent and dominant in the next decade too?
Yeah. So even though I didn't want to ring fence myself to a decade terminology, I was actually trying to avoid that in a lot of my reports. But the reality is the future, firstly on the financial inclusion thing, is a very important variable in my view, and it is going to help, in my view, the entire financial ecosystem. I'll tell you the broader prospects here. See, ultimately the broad anchor of financial inclusion is digitization, right, of all forms, which primarily means that if you're able to succeed in the second phase of digitization, which is ONDC or OCEN, which some extent sits on the ONDC network as well, you're able to primarily get a lot of data on small scale companies, retailers. You can do a lot of B2B work as well there. Now that primarily is the basis on which you're going to be giving microcredits across the board, right? And that point of time, even larger banks can participate through those channels, right? So which means for the economy, you're getting, low cost funding, lower cost funding than you would normally do for that set of an audience. It's a pretty large audience. So that's actually good for the economy to a large extent. And for financial sector at the top end, they couldn't really have tap that opportunity, right? So they will be able to tap that opportunity, which means credit growth could also sort of look up. So this is one broad construct of what I basically see digitization and financial inclusion playing over a period of time. And this is across the board financial stocks, right? So this is not just about one of the consumer tech digital companies on the fintech side that we actually have a buy on as a house, but this is not just about that. We're looking at beyond that. The second part, very quickly on infrastructure. See, a lot of infrastructure has been government dominated in the last few years. Part of that was actually the right approach. We've been writing on this even like 5-6 years back, that the historic infra models of PPP actually were very faulty in nature. So to some extent, the heavy lifting has been done by the government. And I believe that to a large extent that will continue. Only thing is the contours of infra spend will probably shift towards power sector, where a lot of private participation would essentially come in. So if at all private sector participation plays in that, but things like roads or railways or even metro, they have to be government dominated. That provides opportunities across the board. Honestly, cement is one aspect to it, but then you have large construction companies as well. One of the largest ones, I still believe, has a lot of room to see returns from here, from a stock point of view as well.
Right. Venugopal, hi, morning. Given the fact that you have spoken about how India has already seen a focus on infrastructure and manufacturing, what is the way forward? Because it needs to be emphasis, as per the report, on a consistent and a dedicated push. How critical will this be to our growth?
Yeah, see, one of the key things I want to highlight is, they would probably have seen another of these, detailed thesis of words on India, China. I mean, it's a very well talked about topic, even in history, but probably more pertinent at this juncture as well. See, consistency of policies is a fairly important variable for us seeing through, policies getting executed. And that's where I guess historically, we've had some challenges. A part of that was because we used to be very top-down policy making, but execution used to be left to a lot of other things, including states or private sector, which never really played out the way we would want it to play out. Now, the reality is, at least from what I understand at this juncture, meeting government officials, trying to see what corporates are doing, at least to a large extent, there's a consistency in policy and execution to an extent. Yes, there have been failures. There have been probably slower pace at which manufacturing could shift because to an extent, we're in a very different era of globalization as well, with quality globalization. So that also doesn't make it very easy for us to, get outright overnight wins. But the reality is this, that let's say next year we have a change of government. How will policies change? Will manufacturing get the same love that it was getting earlier? Will infra policies be changed from government to private, and then we'll get into mishaps again? We really need to watch that honestly. So that's like the unfortunate reality of India versus China. China is able to control its land, labor, resources, policies, and financial sector very deeply, through the political system they have. Right? We don't want to really go to that political system, but the reality is we have our own limitations as a country.
The relative difference between India and China is at its peak. underperformance and outperformance that is adding to this relative outperformance largely. Do you think somewhere the risk reward ratio now from global asset allocator is in favor of China? So India may be a great story, but it is like saying I'm buying gold at the price of diamond.
I'm short gold, by the way, but just to put in another perspective,
and long diamonds.
Long diamonds on a very different note, but short gold for sure in the India portfolio. But just to put in perspective, this is a very important question you raised about the flow aspect to how India is looked at versus China. See, honestly, China is a much bigger weight, in the index as well, and people globally would love China to do well because it's going to help their portfolios as well. I don't think there is a major rebalancing which has happened towards India. Okay, so if we had seen major rebalancing, we'll have seen $50 billion of flows, not like $5-6 billion of inflow. So that's the fundamental reality. We get to see that balance change. Number two is that, valuation gap is very high right now, which is India, of course, is, a relatively higher valuation versus China. But if you were to generally look at history, India's earnings growth has been significantly higher than that of China. It's actually India's earnings growth historically has been the highest across the world, right? So that's the reason why India tends to be trading at higher valuation. And second thing is governance, which is an aspect where, India in general, Indian companies are much better. That's the fundamental reality construct of basically the index as well. Now, but at this juncture, what I do see is that the global investors, I have never seen them as negative on China that, it was no longer about cyclical issues. They're talking about structural issues primarily. And they seem to be more confident about those structural issues than they were a year back. So that makes me a bit, sort of worried that, are people too negative on China and we could see a bounce back, because of that factor, especially from perspective. It could happen, but does it really matter is my question, because see, a lot of us tend to take 12-month, 24-month calls by nature. So it doesn't really bother me, as long as India is fine. But I don't disagree with your opinion on valuation gap and trading rallies from time to time.
Okay. You mentioned banks at the beginning of the show. I'd like to throw in IT. Now, IT, whatever could go right has gone wrong for, whatever could go wrong has gone wrong for IT. Whatever right could go has gone wrong for banks. And that, some would say, is the challenge, right? For banks, incrementally nothing new will come. For IT, incrementally nothing bad will come. And that's how markets move. I mean, they're pricing in all the good news for banks and they're pricing in all the bad news for IT.
Okay, so that's an interesting one. I would sort of highlight that as far as financial sector is concerned, I don't think the story is over. I mean, this is after a long time. We have visibility on credit growth, which could last for a few years, decent credit growth. And, credit quality, which is essentially very, very strong. And I also believe digitization is going to be supportive to the financial sector rather than being disruptive. All of that is in place. And I don't think these stocks have essentially done well as well. And they're not like, changed too much. They're not too costly as well based on the kind of growth profile that we expect over the medium term. Yes, they could have, those tactical issues around NIM, around rate changes and all. But I think actually that is priced in. So that's the way I look at financial sector. I think the story is not over. In my view. But if I look at IT sector, I mean, I don't know whether we should say that everything is priced in yet. It's a different thing that we are actually overweight IT as well. So, but then we were overweight IT. Very nicely, we had actually creeped into IT overweight and funded that to consumer tech than pure IT services, which is when we realized that, there are going to be some challenges which we can't really quantify. So we are more overweight in consumer tech within IT, right? So that's where our weights are. But looking forward in the next 6 to 12 months, I would probably say that, look, end of the day, the worries that people have, especially around global growth and global meltdown, have been proven wrong to some extent, especially about global growth, right? Things have actually held up fairly well, even in the US. And we are not going to be seeing the GFC kind of a situation. So at some point of time, the market realization would also be that, hey, things like AI are actually going to be positive drivers. They won't be initially anyways, in terms of, order flows and stuff. So once there is a certainty of bottom, that is where you'll probably see IT violently move up. Is it going to happen in the next 2-3 months? I don't think so. Could it happen in a 12-month to 18-month time frame? There's a possibility of that, right? Given that valuations have also come down. The classic question here is, well, one of the larger companies in this space, for of course, downgraded guidance. Is that downgrade of guidance sufficient enough? Is 1 to 3% growth sufficient enough? Or are they going to be -1, right? That's what the market is looking at this juncture.
Okay, Venu, great to have you on the show. Thank you so much, as always, for taking the time out and sharing with us your thoughts.
Thanks.
Okay, let's just quickly revisit what the market then is up to right now. And we've had a decent start for ourselves. Quiet, but mildly positive at that. Nalco, SAIL, Tata Steel, NMDC, all your gains today are within the entire metals pack. And then, of course, there's Shree Cement as well, post that upgrade and the channel checks suggesting a price hike in the month gone by. They're all the ones which are holding up very, very smartly in trade. In fact, across the cement pack, you are seeing decent moves. And remember, on Friday, you already had a big move come in on India Cement and the likes. And today, too, that trend is continuing itself. But let's move on and let's talk about what's the growth roadmap that Vinity Organics has for them. The rising crude prices, are they going to aid their key businesses? What's going to be the impact of it all? Vinity Saraf Mutreja joins in on the show right now. Vinity, great to have you. Let's firstly start off with your ATB segment. This has been weakish of late, but now with crude oil prices rising and increased demand in oil rigs as well, how's your volume, offtake and pricing looking like?
See, frankly, ATBS, last couple of years and especially last year, our customers purchased too much. I think in the beginning of this fiscal year, they realized they're sitting on a lot of inventory, and so there's destocking that's been going on for the last 4-5 months. Even though the demand remains stable, so the consumption is stable. It's just that there was excess inventory towards the beginning of this year around March, which is getting consumed now. So ATB's offtake has been slow starting April. I expect it, to remain slow till September, and maybe the offtake will pick up starting October, November, towards the end of this year.
Also, the capex was delayed in ATBS. What is the status currently, and what are the capex and are the capex plans on track?
Yes, so the capex for the new line of ATBS is on stream. It's on track. I don't know, maybe it will be ready by April, May. But given the long-term outlook, for the capex for ATBS, it's a 10-year outlook, and that is why we are building this line, as well as the other capex is concerned, which is primarily in Viral Organics. That's also on track for a new product segment, and that will be ready by March, April 24.
Now, your other segment, IBB, can you tell us, Vinity, what is the outlook here?
IBB is, has been a stable product for us. Last year, actually, there was a pickup compared to the previous year, which was slow because the year before that was quite good. Other than, few monthly variations, this year should be stable. Ibuprofen as a drug is doing all right. Our largest competitor actually has not been producing IBB for the last few months. So that segment is doing all right for us.
Right. So are you suggesting that the competitive intensity in IBB segment has been reducing, and what does it mean in terms of your market share?
Well, that has been the case for over the last few months. I don't know if this competitive landscape will change or it will remain this way.
So, really, any update on the merger of Viral Additives?
Yeah, so the merger has received approvals from shareholders, from debtors. The only thing is pending is with NCLT. That's the last thing that's pending, and we're just waiting it out. Whenever they hear us and take our case, I hope it goes through.
And you're expected, you expected that Viral Additives could contribute close to 150 crores to your top line. Going forward, how much will you increase? Will that increase once your capacity utilization increases?
Well, the total potential of Viral Additives is much more, is about 700 crores. It's just that it started last year, middle of last year, and it has been very slow. The demand for those products, actually, it's been a very sluggish market in polymers, in plastics where it is used. So given that, today we are running at about 25-30% capacity utilization, which I see picking up towards the beginning of next year. So hopefully, with we should reach full capacity utilization maybe over the next 2 years or 2.5 years or so.
Any plans of merging Viral Organics with the parent company anytime in the future as well? And also any guidance on the revenues that you can expect from the subsidiary?
See, Viral Organics is anyways 100% owned subsidiary of Vinity. I don't think we will be merging that. That probably will remain a subsidiary. Given that it will be the first year of operation of FY25, will be the first year of operation for Viral Organics. It's hard to give a number of how much it will add in revenues, but maybe 50 to 100 crores, but still very tough to say.
And you're also working on R&D in anisole chemistry and antioxidant industry products, which are higher margin products. So can we see your margins expand in FY24?
See, our margins this year have remained stable if you compare it to FY23. Somewhere in the range of 28%. I don't think this will increase. One can expect a similar margin profile, over the next 2 to 3 years, blended margin profile, because butyl phenols, I've said again and again, do have a smaller margin, less margins compared to the sales. And that market share is also increasing. We're achieving more capacity utilization in that segment, and that continues to add revenues to our product mix. So I would expect margins to remain in this similar range over the next 2 to 3 years.
Sure. Vinity, ATPS contributes to about 40%, while IBB contributes 20% to your revenues. Now that you're going to be delivering new products like antioxidants, anisole, how do you think your revenue change is going to, or rather mix is going to change in the next 2 to 3 years?
I think you can get that estimate. ATBS share has already come down to less than 50%, but with the new line coming on stream and seeing how the demand for ATBS pans out, total potential of anisole, MEHQ, Guaiacol revenue potential is not more than 300 crores, for our company. So I don't think over the next 3 years, say we achieve full utilization of viral additives, of ATBS, of butyl phenols, the Viral Organics would still be less than 10% of our overall revenue.
Now, more than 60% of your business comes from exports. So what are your client conversations looking like? What's the export outlook?
I think we have reached the bottom. I would like to believe, and at least from what I'm seeing, the worst is behind us. Europe has been slow. China has also been slow. But the US is picking up. Most of them now seem positive. They're saying end of the year, we will see demand pick up. So let's see, keeping fingers crossed.
Right, but does the revenue and margin guidance for FY24 remain intact?
No changes to that.
Right. Vinity, great to have you on the show. Thank you so much for taking the time out and highlighting what's going on with the company. Let me just quickly revisit what the market as well has settled in at. And we're comfortably above that 19,500 print. So while it may be a quiet, muted start, it's a good one at that. It's really metals all the way. So Tata Steel, Hindalco, Nalco has shot up nearly 8% now in trade. SAIL was a big mover in Friday's session and right now also holding up 4.5% as we speak. NMDC being the other one, which is also a big winner. Besides metals, of course, cement, financials, technology, they're the ones which are also holding out smartly in trade. But from chemicals, now let's talk autos. That's where all the action has been, especially after the data coming in for the month gone by, the month of August, that is. Let's take stock of what the picture is really, not just for the month gone by, what the trends are indicating, but ahead of the festive season. What's it looking like? We have with us Manish Raj Singhania, the president at FARA, joining in on the show. And we will also have Kumar Rakesh join in just a short while from now. But Manish, great to have you today on ET Now. Thank you so much for taking the time out and joining in. Firstly, wanted to understand how the industry is gearing up for the festive season. Because, we were just chatting with Shashank Srivastava from Maruti just the other day, and he said that for some of their models, the older ones at that, the inventory is as high as 4 years. So wanted to understand from you whether we're looking at a big discount season as well coming up ahead.
So, good morning, yeah. If you look at the April to July industry, overall industry has been very positive, automotive industry, and car segment has been growing by almost almost 3%, and two-wheelers have been growing by almost 4%. So overall, please understand that last year passenger car industry achieved an all-time high figure, and surpassing all these high retail volume peaks is a tough task. But with improved supplies and higher incremental production levels of various OEMs, we are able to attend to or address the customer requirements better. And coming to the festive season, we are very positive about the festive season. Dealers across India have been accumulating stock. As you can see in our July press release, we quoted that paid up stock with PV dealers is almost close to 55 days. And that's the kind of expectation that is there from the auto industry and the festive market. Also, dealers also are preparing that last time, there were a lot of misses because there was huge shortage of models and we could not address the consumer demands and customer requirements. But this time, dealers are more cautious. They are picking up stocks so that they are able to attend to customer requirements and demands. Various kind of bookings, vary now. The model range is huge. SUV segment is kicking. And yes, definitely, I would say consumers can expect a better scheme and better demand because if you look at it, across every OEM, whatever the OEM, their entry-level cars, passenger cars are not doing that well. And to attract the customer to that product portfolio, OEM and dealers would definitely roll out red carpets for the customers to come and buy during the festive season. But what I want to caution is, if the customer wants the right vehicle and right model, he or she should book right now because during festive season, normally there is a crisis. And if you want your right model, then it's the right time to book the vehicle now.
Okay. So when you say the demand for sedan is not looking that great, is this only a sedan specific issue? Or is this a company specific issue, or this is about the affordability, what is happening in the rural India?
So yes, definitely, it's not only sedan, it's about the entry-level cars also. And we definitely know that rural market is not able to perform as it is required to do so. And it has been struggling. In our July press release, we predicted a below average monsoon in August, and we are seeing almost a 30% deficit in monsoon this August. So all this will augur, not a reliable market, or festivities in rural market won't be that good. But normally, looking to the last year trends, even though markets are not doing well in rural market, customers tend to come out during festival times and pick up their choice of vehicles. You can see a positive growth, a positive trend last 2 years. Even though there was stress in rural markets, the still customers came out during festival times. On an average, we were still on a degrowth, but during festival times, the rural market definitely responded. So yes, there is a huge potential there, but due to lack of rainfall, the right quality and right quantity of crop won't be available for the farmers. And this MSP buying by the government, and it is a critical factor in the fund flow for the rural economy. And if we don't have the right quantity of crop, so hence you will have less money in the hands of farmers. So rural economy would be kind of stressed in the long term.
All right, Kumar Rakesh also joins us, India analyst with BNP Paribas. Kumar, auto stocks, let's say a month ago, were at a relative high. And with the exception of CVs, most of the auto stocks have retreated quite a bit. Given that there seems to be now this change of trend between in four-wheeler from sedan to SUV, Do you think this is something which markets have already factored in, because the recent outperformance in Mahindra and Mahindra, and for that matter Maruti, is a clear indication of how markets are aligning to the new shift?
Hi, good morning, Nitin. Thank you for having me. If you recall, early last month, I was here on your show as well, and we were talking about that now is the time to start getting more selective in the auto space. So far in the year, we have seen the entire auto space outperforming the broader index, and that possibly will start changing as the demand patterns across different segments have started digressing quite significantly. And that is something which the recent auto sales numbers are also indicating, and possibly will continue for the rest of this fiscal year as well. And investors also have started aligning themselves. And it's not just the demand side of the equation which we have to be mindful of. Also on the commodity pressure side is something which we have to be quite watchful. We maintain our commodity basket of all the commodities which goes into a typical passenger vehicle and two-wheelers. It had been coming down so far in this year, but last month that also went up, specifically because of the steel prices going up. And if you would listen to the commentary from the steel companies, they are talking about that the steel prices have started bottoming out, and they would expect steel prices going up in the coming months, possibly by the third quarter. And if that starts happening, the margin side of the equation also will start getting more stressed. So we should rather start aligning from stock preference perspective, more to stocks which are still seeing demand, which can possibly offset the higher commodity pressure. Whereas the segments which are going to see demand pressure will see far higher impact of any commodity stiffening.
I'd like to draw your attention to what's happening, Kumar, to the two-wheeler space. And if I look at the numbers which came out, let's say both from Mahindra, both from Bajaj and from other two-wheelers, they're just pointing to one trend, which is that the premium luxury bike will do well, and the affordable luxury bike segment is where the competition will intensify. How long before the base effect will start kicking in? Do you think from a market standpoint, now it's time to look at the other end of the spectrum, because luxury will hit a peak in terms of base and rural or entry level will hit a base in terms of comeback?
Nikunj, if you see the entry segment of the two-wheeler industry over the last 4 years, they have seen a price increase of almost 40%. And that's a very sharp price increase for different reasons. And I'm talking about the on-road prices, for the insurance price increase, then the emission norm kicked in, and then the commodity prices went up. And now it will obviously have a price elasticity impact, something which we saw over the last 2-3 years play out. And hence the overall industry volume, what peaked at 21 million in FY19, ended close to about 16 million last year. And we believe this is largely a reflection of the price elasticity absorbing the higher prices. From here on, we should be seeing a more normalized growth. If you look at the last long-term average industry growth of 30-40 years, the industry has grown at about 8%. And given that we have far higher number of two-wheelers now in the market, the penetration is much higher, the growth would be much lower than what the long-term average of the industry has been. And of course, within that, the entry segment would be at much lower than that. And the premium segment, which you are talking about, where there's much higher competition, will see a higher growth. And possibly that's why we are seeing a much higher competition as well, because most of the OEMs are realizing that the industry is premiumizing and the demand is shifting towards those segments. And also the affordability of the consumers in that segment is better, and price elasticity is less compared to the entry segment.
And what about, let's say, dual plays like Bajaj Auto? Bit of domestic and a lot of export. What happens there?
They are definitely, because of the diversification the company has, they definitely benefit to some extent. But when we look at the overall automotive basket, the segments like commercial vehicle, where we still are seeing a strong upcycle, passenger vehicle, where the demand is far more resilient, and the long-term structural growth story is there because penetration is still quite low for passenger vehicles in the country. Those companies would be better placed. But within the two-wheeler basket, you are right. The companies with much diversified portfolio will be better off.
All right. Thanks so much for taking time out and giving us a lot more clarity on how trends are shaping up within the entire auto space and what the outlook is going forward. What's going on in the markets then, and inching towards the 19,500 mark as we speak. You've got the broader markets which are continuing to show you pretty smart traction. Which are the sectors that are contributing on the upside? I'd say all of them, but mild downtick for FMCG, but it's metals, PSC, and even the PSU banks that are really charging ahead in today's trading day. Let's run you through some of the winners in today's session. You've yet again got some of those rail stocks that are chugging along, or should I say at fast speed. Rail Vikas Nigam piling on another solid 12% in intraday trade. Ircon International looking very smart. Just pull up some of the other names within this entire space, the likes of Atitagar, Wagons, etc., given the fact that we've already seen a pretty strong run-up in these stocks. All right, let's move right on. Sanjay Shah is with us. He's CMD at Prudent Corporate Advisory Services, here to talk about the AMC space and what the outlook is on the non-MF business. Good to have you on board. Thanks so much for taking time out. Sanjay, to begin with, there are a lot more entrants that are entering the AMC space, be it Jio Financial, Bajaj Finserv, etc. What kind of growth synergies do you see for your company in light of this?
I think if you look at overall industry, mutual fund industry is getting very, very intense with the announcement of many players entering this segment. However, if you look at the positioning of Prudent, we are the pure B2B player in this segment where we do not have any conflict of interest. We might be the only large distributor who doesn't have any manufacturing, captive manufacturing. So probably I believe that our role becomes more and more important, because if you look at the positioning of Prudent today, we provide the business to mutual fund manufacture all the AMCs from every nook and corner of the country. We have the trust of almost 30,000 mutual fund distributors of the country. So probably it is very important for them to align their interest with us, because if they just align their interest with us, we start providing the business from almost 30,000 people. So which is about 20% of country's distributors. So I feel Prudent is very well poised for capturing this momentum on the growth side.
What happens when a BlackRock and a Jio kind of an arrangement comes out? It could be tilted more towards ETF. It could be different scale, reach, size. Your advantage is unique. You are a B2B, B2B company. But when a B2C large technology-based player is going to be going after ETFs, could that change the dynamics?
So probably, I think if you look at the message which is coming from the Jio, I think they are trying to capture the market on the manufacturing side, not on the distribution side. So for them also, I think they require to have some kind of tie-up with the distributors also, apart from their own strong reach on the ground level. However, sir, I still believe that this is not a business which is a DIY business, because initially you might start investing into the funds on your own, but however, as your size increases, some point of time you'll need the help of an advisor, and today country doesn't have a large number of advisors. So probably as industry becomes more and more mature, the role of advisors stroke distributors will become very, very important. So I think, as if you look at last couple of years, all the fintech has helped in expanding the market by adding all the new age investors into the platform. Now we believe that Jio will help to expand the market, and which is virtually helpful to us only, or all the countries mutual distributors will be the beneficiary for this.
I'd like to change the gears of the discussion and talk about what is happening to the inflows and outflows. While the SIP number is very impressive, but if I look at the net number, which is SIP minus the total outflow, that number is also increasing. So instead of a net flow of about 10,000, 11,000 crore, now that number we understand has come down to 7,000 to 8,000 crore. Is that a concern that the net inflow into mutual fund industry, especially equity, is contracting now? Even the markets are going higher, flows are coming down. ये हमेशा उल्टा होता है. When markets go higher, flows go up. But right now it's different.
So actually, Nikunj bhai, if you look at, I think that shows the mature behavior of the people. So there are two parts of the flow which comes from the retail investor. I'm just talking about purely retail. So one is the SIP book, which is definitely increasing at a rapid pace, which is probably, if you look at the advantage of SIP book, because you are investing regularly, probably you are buying at all the levels, you don't require to time the market. That money is coming very, very strongly. However, lump sum money, which used to come at a better speed, has came down in this current year from April to July. If I take about Prudent's number, we used to roughly about 500 crore of gross sales. I think that number has came down to now 300 crore. So that shows some kind of mature behavior, and the definitely redemption was very, very strong in the first quarter of April, May, June. However, it it came down a little bit. So I think some kind of probably the slowness in the redemption has came in the month of July and August also. But still, overall, that shows that market is not into a strong bull mode where everybody is just saying that goes on buying and buying and buying. So probably that's a very mature behavior. And we believe some kind of slowness, consolidation in the flow is always advisable, because it should not happen that people just goes on buying by looking at the historical return. So two things on the small cap and mid cap side, we wish that some kind of inflow start coming down, tapering down, and the flow from the lump sum side also should come down. However, I think the SIP is the huge catalyst for money, and which we believe that even today also, probably if you look at last 3 months, we're also seeing that the traction on the SIP side has not came down.
So what is the net number according to you? Because every AMC gives me a different number. So I thought I'll ask distributor the right number.
So I think it's very difficult to do the number crunching on the industry side, but I can tell you my number is better than the July number. So July ke samne mera August number acha hai, and if I am representative of the industry, I think August might be reasonably better, not that great. SIP, because I can tell you we are also going to touch 600 crore of book in this month. So I think SIP, which was about 550 crores. So I think the SIP is growing very fast. We started the year at about 20 lakhs at 530 crore. We are now at close to 600 crore. So we had almost 70 crore of SIP book and almost about 2.5 lakh SIPs. So that shows that SIP book is something which is growing very fast.
Okay. Do you see the trend changing in any of the large categories, balance advantage, or for that matter, small and mid cap? Because one is managing risk, second is extreme risk. You mentioned about small cap, so I just wanted to take that point for forward.
Still, I think the traction on the mid cap and small cap is visible because of the historical return. However, I think a couple of AMCs are playing this situation very smartly by restricting the new inflow and just allowing money to come to that segment through SIP. And we also advocate all our retail investors that if you want to participate in mid cap and small cap still, then probably look at only SIP from a next 5-7 years view. We are strongly communicating message, even through your medium also wanted to say that if you look at SIP, mid cap and small cap, please look at now from a 5-7 years perspective. Otherwise, there might be a possibility you get a disappointment on the shorter term horizon. But I think the small and mid cap, you are right, some kind of froth is visible, and we believe that if money comes to SIP, it will be okay. On the balance advantage side, I think still inflow is there. But as the returns of this category has started tapering down, some amount of slowness is visible in that particular segment. So it's always probably the important thing is to manage the behavior and the market cycle between a couple of large segments.
Just give us a quick sense as to what the outlook is when it comes to your overall margin picture above 30% by Q2. Do you think that this is possible, and what would be your margin drivers?
Yeah, so I think probably if you look at, we truly represent the entire mutual fund industry as well as entire wealth management space, and our major driver as far as our earning is concerned is coming from the growth in the AUM as well as growth in the SIP book, as well as number of new partners joining Prudent as their preferred business associates. So if you look at all these three numbers, we are doing pretty well. So I think the current year we are very fortunate that even though the net sales was reasonably under the control, mark to market has supported very well. So if you look at from April to now, mark to market gain on the AUM side is almost about 17-18%. That has supported well. So historically, we always say that the AUM growth either comes from, so it comes from two segments. One is a SIP book, and second is the mark to market gain. Some point of time, mark to market gain might support or may not support. Last year, mark to market gain was not visible. It was not there in our AUM side, but however, in the current, it has supported very well. So that number one. Number two, SIP book is growing, as I already told you, is going at a very fast pace, and the comfort of people joining our platform is still very well, because we add about 300-400 partners to our kitty every month. So that number is also very strong. So all put together, I think we already gave a guidance that in next 2.5 years, we want to reach a magic number of 1 lakh crore of total AUM and 1,000 crore of SIP book. So I think we are very much on track. We are almost close to 68,000 crore of AUM and almost close to about 600 crore of our SIP book is concerned.
Appreciate your time. Thanks so much for joining in and sharing with us your outlook. All right, let's move right on and hear it out from Samir Arora. He was in our studios just last week and he said that banks are in a good space. In fact, he believes that HDFC Bank is actually his contra bet. Listen in.
According to us, all the times, by the way, we show this in one of our presentations, that nearly no fund, nearly ever, has got even the performance which the 150th stock of the index has.
So there's no FOMO, you're saying?
Correct, because there's so many of them. Yeah. Imagine that if you just rank last year's rank, the 150th stock was from the index, and you're not talking about some non-index stock, was up 16%. Which fund, general diversified fund, was up 16%? None. In the 18 years, I have only managed to get the 150th stock performance 3-4 times for the full fund. And really nobody ever gets it, or once in a while somebody gets it. So that means so many stocks do well. So if so many stocks do well, why bother about FOMO? You could use that for Tata Motor if you so desired. That it doesn't matter, you are not going up alone. So let me choose my factors which I like, and maybe 10 stocks I thought will not do well. So in theory, there's 140 more that are going up and I can choose from that, but I don't need to compromise. I think that is the big picture.
But since you talked about it being a flexi-cap fund, is there a bias that you have right now, given that mid-caps are the ones which are at an all-time high and maybe some value in large caps right now?
We don't know that, the fund manager will decide, but broadly in a big picture sense, if we look at our history, it'll be 50 to 60% large cap. Because, we like the big fellows, which is the banks. And
which are not doing anything.
No,
right
that
now.
is good. That is, you are storing something for the future. Means you have to keep chiseling away. So the good thing is now mid-caps, they are charging or waiting, like in a relay, you're waiting for your turn. There is no way that if you believe that flows are coming in from domestics and from foreigners, that one day plus minus a few months it won't happen.
No, I don't know if these goodies came via Zomato, but I know that is a stock that you'll look at very closely. But recently there have been so many IPOs hitting the market, but I believe that you've said that they're very overpriced. What's the view?
So on Zomato, may I say that you were the first guys we told when it was 52. The thing is, when it is falling every day, to come and say that we own it or we've just bought it, rather than now when everybody is buying it.
Are you selling it now then?
No, we are not selling now because अब वो ठीक है, वो Blinkit की story बना रहे हैं, अब चलने दे सकते हैं क्योंकि it is in proper this thing and they are doing well. So on the new IPO now, I haven't seen all of them, but the ones which our fellows saw broadly, they are like that drone fellow and all. It's too much.
Why there's so many block deals happening? Just so many block deals, promoters after promoters.
Beyond anything.
What does that mean?
But this is showing the appetite of the foreign investor on the other side, because the seller is also mostly foreign in these.
Even promoters are selling this.
But PE guys mostly, let's say. And the other side is the domestic, and they feel that you won't be able to buy it on the screen because they're slightly liquid, or the size of the Indian industry has become so big. We never had it in our alliance days when I was the biggest mutual fund manager in a private space in equities. So it is just the size. But main thing is that you are supposed to have this kind of in every market.
Okay, let's split the IT space into two. The traditional business.
And the newer guys.
Newer
means the
so-called the SaaS guys, the new age tech. When I say new age, the specialized IT companies. You go to MapMyIndia, go to RateGain. These are specialized.
So those we have, by the way.
We
have KPIT also and we have RateGain also.
Okay.
But we don't have these regular TCS, typical Infi and HCL Tech and all that.
But within that, Samir, I can divide that traditional model into two parts. The old business and the new business. The old business is something which will grow at 7-8%. And the new business which will get challenged because of AI. So old business is a function of what happens to the US economy. And US economy is making a comeback. Beginning of the year and now, the outlook for US macro has changed. So will that incrementally change the way how IT cycle will move?
The thing is, I don't think those company things have changed. Simple thing is, look at the hiring of these fellows. They are not hiring. They themselves don't believe. They are not honoring their school commitments or whatever. So they are showing to you.
Cash-rich balance sheets.
So then why are they acting like this? Why are they negotiating salaries of a starting guy by saying give another exam? I don't have to give names of all these fellows. That is also otherwise. What does it show about their own confidence?
Helios is hiring what, right?
Helios is hiring more than Wipro is hiring because they're net negative.
That's why I asked you this.
But what are the contra bets in the market? Is there anything contra right now or undervalued?
My number one holding is contra, HDFC Bank. which hasn't done anything
That's
for
also
3
there.
years.
Consensus has become contra. Can you imagine HDFC Bank being called a contra call? What
For
times are
3
we
years,
living in?
zero
What
return.
times are we
And
living in?
still
The darling
number
of the
one.
market has become a
But by the
contra
way,
bet.
we met them. They have come to Singapore. I think they are very good. Let's see.
What is the consensus bet then?
Consensus bet might be ICICI then in that case.
What about Geo Financials?
Geo Financials, if it went to some 180, I'll buy. See, we just made a thumb rule that for the Reliance shares, we can give them, say, 10-20% discount.
Invest in the share market.